The profit and loss and balance sheet are two key financial reports that describe the transactions and financial health of your company. How do you know if your financial reports are accurate, though? Hi, my name is Becky Shepard, and I'm a certified public accountant. Today, I'm going to walk you through your financial reports and show you how you can have confidence in your numbers. We're going to be working in a sample file today, and from the home screen, you're going to click on the left-hand menu bar where it says Reports. The two key financial reports that we're going to focus on is your balance sheet and your profit and loss. In my particular file, they're marked as favorites. If they're not marked as favorites in your file, then just scroll down to the business overview section and you'll find them there. Make sure you're selecting the regular balance sheet and the regular profit and loss and not the other options in between. We're going to start with the balance sheet. The balance sheet is super important because what it reflects is a snapshot of your company at any particular date and time. It's going to show your assets, it's going to show your liabilities, and it's going to show your equity. Now, assets represent money that you have, money that other people owe you, or things that you own, like, for instance, a truck or a piece of equipment or a building. Liabilities are going to represent money that you owe other people, money that you have on a credit card, money that you may owe for payroll taxes or for sales tax, or for long-term notes payable, like your vehicle loan or your mortgage on the building. And then you have your equity, and that is your stake in the company and your retained earnings, your net income that you're making for that particular period. As long as you can prove your balance sheet numbers and your balance sheet numbers are good, then for the most part, the profit and loss is going to fall in line. So you want to put most of your efforts on the balance sheet to make sure that these numbers are accurate and provable. So how do you prove these numbers? You start with the top. If we're looking at the top, we see we have a checking account and we have a savings account. The way that you prove those numbers is through the reconciliation process. Now, I'm going to do a little trick right here that you may not know about, so hopefully this is something new for you to learn. If you want to stay on the screen that you are on currently, but you also want to open up another tab or another screen, then all you have to do is duplicate the tab that you're on. And to do so, if you hover your mouse up at the top tab, you can right-click and you can say Duplicate. So now you can stay on this particular screen with a balance sheet, but then you can use this other tab to do something else. And this something else that we're going to do is to go check on the reconciliations in the file. To do that, I'm going to click the gear in the upper right-hand corner and I'm going to click on Reconcile. So what you see in this file right here tells me that this account has never been reconciled. And the way I know that is because there's no previous reconciliation date. If you have reconciled in the past, it's going to show you the last reconciliation date. And you want to make sure that that's a process that you're following every single month to reconcile those accounts on a monthly basis. Now, the reconciliation process is simply taking the bank statement from the bank and comparing it against the transactions within the QuickBooks file. We have an entirely different video on the reconciliation process, but I want to make sure you understand that proving these numbers includes verifying that these reconciliations have been done. And when I say that the reconciliation has been done, that includes verifying that there's not any hanging transactions that don't belong. So if you're reconciling the month of May and you have a deposit that has not cleared the bank from January, you have a problem and you need to research why that deposit from January has not cleared the bank. Likewise, if you have an expense on a debit card that has not cleared the bank account, you need to research and find out why, because debit card transactions are real time, they're automatic, they don't sit there and hang. The only transaction that you might have remaining are going to be checks that you have written and perhaps recorded in QuickBooks that have not yet cleared the bank, and those are okay. My point is, when you're doing the reconciliation process, if you have outstanding items, you want to know why those items are outstanding. So back over here to our balance sheet. Again, the way we prove these numbers here is to reconcile those accounts. And as long as you've reconciled those accounts and you don't have any hanging items, then you can mark those items as being good. Moving right along, the next item is accounts receivable. How do we know that this item is good? So the amount says $5,281.52. We're going to go to the detail report that makes up that number. So we're going to flip back on our other tab, and I'm going to go to the reporting menu. I'm going to scroll down to the section that refers to who owes you, and I'm going to click on the Open Invoices report. And if we look at the bottom on this Open Invoices report, I'm going to scroll all the way down, our balance is $5,281.52, which does indeed match the $5,281.52. Now, just because that number matches does not mean that number is good. So here's how you prove that number. You look at your Open Invoices report and you make sure that everything on this report is indeed valid, that every invoice out here is still outstanding. There's not anything old on here that hasn't, been cleared out. There's not any credits, that haven't been applied. And once you have verified that that Open Invoices report is correct, as long as that number matches what's on the balance sheet, then you can say you have proved that number. That number is good. All right, moving right along. For other current assets, we have inventory asset of $596.25. You want to make sure that you are following the inventory process. Now, different people have different inventory processes that they follow. Some people use a periodic inventory system, and some people use a perpetual inventory system. When you're doing a periodic inventory system, you're simply recording adjustments every month or every quarter to equal that dollar amount of inventory that you have in the system. If you're doing perpetual inventory, then you're actually using the inventory module within QuickBooks to receive items and to sell items and perhaps do inventory adjustments for shrinkage or for damaged products or whatnot. So the way that you are going to prove that number is going to depend on which module you follow. If you're doing the perpetual inventory or if you're doing a periodic inventory. If you're doing a periodic inventory, you want to make sure that you have done your adjustments on that periodic basis that you have established. For instance, here, it looks like this is going to be on a perpetual basis. And the reason I say it's on a perpetual basis is because inventory is being sold with invoices. It's being, inventory is being added to the system through bills. There's some checks in here for additional inventory purchases. So this number, assuming that the inventory counts have been done, should be a good number. Let's go back to our summary report. Our next line item is undeposited funds. So we have $2,062.52 in undeposited funds. How in the world do we prove that number? Well, I can guarantee you it's not by clicking that dollar amount and seeing the detail report. If we click that dollar amount and go into the detail report, what you're going to find is a huge conglomeration of numbers, and you don't know what's what without going through line by line and matching things up. That is not your solution. Let's go back to that summary report. The way we prove this number is by looking at the bank deposit detail. So it says $2,062.52. Let's flip over to our other tab and let's pretend like we're making a deposit. So I'm going to click on that plus new at the top, and then I'm going to say bank deposit. And if you notice, I have two transactions that are waiting to be deposited at the end of May. Actually, we're sitting here in June and they never got deposited for May. So that could possibly be a problem. But what that number is $2,062.52. So assuming you still have those checks sitting on your desk and you haven't actually taken them to the bank, then you can say, okay, that number matches my balance sheet showing $2,062.52 and that number is good. Now, if you don't still have those checks, then you have a problem. You've got to go find out where those checks were deposited and why are they still reflected in undeposited funds. Okay, moving right along, we've got our fixed assets and we have an original cost of $13,495. One thing that you will notice, or at least I hope you notice, that is missing from this is accumulated depreciation. So we've got the original cost in here for $13,495, but there's no depreciation listed, which means that this purchase must have just been done in 2024 and there has not crossed a tax year yet in order to capture that depreciation. So we're just going to take a look at it and see. If I click on that $13,495, we can see that there was a journal entry made on May 15th for the purchase of that truck. So we're good. We don't need any accumulated depreciation. But if we had purchased this in 2023 or 2022 or 2021, you would want to have your depreciation number on here. And that number is calculated as part of the tax return process. If you don't have that number on there, you can refer back to your tax return to find out that dollar amount and post that journal entry appropriately. So once you've proved your assets, you can move on to your liabilities. So for your liabilities, very similar to your accounts receivable, you can prove accounts payable by looking at the detail report. So our accounts payable says $1,602.67. We're going to flip over to our other tab. We're going to close this previous screen that we were on. And then I'm going to go back to the reports module, and I'm going to scroll down, and under the section that says what you owe, I'm going to pull up the unpaid bills report. So the unpaid bills report has an amount of $1,602.67. Well, that matches. Great. You can't say that you have proved that number, though, until you have gone through every single one of these accounts and make sure that they are a valid bill. If you know for sure that these bills are still valid, that you have not paid them, and this number matches what's on the balance sheet, then you can say that you have proved that number. Now we have a credit card, $157.72. The way you're going to prove that number is much like you did with a checking account and savings account. You're going to reconcile that credit card. And again, that's the process over here. If I click the other tab, we'll click on the gear icon and we'll click on reconcile. And then from our drop-down menu, we're going to choose that credit card account. And you want to make sure that you are following that reconciliation process and that there's no hanging transactions that you don't expect. Now under our other current liabilities, this is going to represent things like sales tax payable, payroll taxes payable, possibly some loan payables that's going to be coming due within the first year or for the first 12 months. If it's an other current liability, it's money that you owe to sales tax entities, payroll tax entities, loans that are coming due within 12 months. So the way we prove these is by tracing them forward. So we're going to look at the detail on each of these accounts. So Arizona Department of Revenue has $0 owed. Board of Equalization payable shows $370.94. So if I click on that dollar amount, I can see that we have some invoices and then we have a Q1 payment. So I've got an invoice in February and 2 invoices in March, and then I have a payment that was made in April that says it was for Q1. So if you notice, I had some amounts that were building up and then a payment made that took that amount to 0. And then here in the second quarter, I have some payments that are some charges that are building up. And then we should see a payment at the end of that quarter that again is going to zero out that amount. Payroll liabilities are very similar. Like if you want to know that your payroll liability number is accurate at 12/31, then you want to look in January and you want to see, was the tax payment made in January the same dollar amount that represented the balance shown on 12/31. So you always trace these forward. Whatever the balance is, you look forward and you see, okay, was that amount paid? And if it was not paid, then you need to trace that back and find out why not. Now with this loan payable, again, this is an other current liability, which means this particular loan must represent some kind of transaction that's due within 12 months. So if I click on this $4,000 transaction, it shows that this was a loan that was on May 28th of 24. Perhaps we borrowed some money from a friend or a relative. Maybe we took out a quick loan from a loan shark that's going to have to be paid back in 30 days. We don't know exactly, but this loan was just taken out. If it's a loan that incurs interest, you need to have the interest that's posted against this account. And like your checking account and your savings account and your credit card, your loan accounts can be reconciled and should be reconciled. You would follow the exact same process for this loan payable and also this notes payable for $25,000. The way you're going to verify those is with the statements that you would get from that loan company. You would go in and you would post the interest to those particular accounts, and then you would reconcile them. So over on our other tab, we would click on the reconcile button, and then you're going to select that either that loans payable or the notes payable and do that reconciliation process. Now, under your equity section, this number right here sticks out like a big red sore thumb to me. You should never have anything sitting in opening balance equity. Opening balance equity is essentially a clearing account. You're not going to have anything there. So if you have a number sitting in opening balance equity, you have a problem that needs to be fixed. So I'm going to click on it and I'm going to see what these transactions are. So it looks like some of these were opening balances, like for instance, for maybe like the opening balance for the checking account, an opening balance, for the savings account, opening balance for the loans. This is not an appropriate entry for opening balance equity. The reason why is, for this checking account, the original $5,000 that was deposited, where did it come from? If it came from the owner, then it should be under owner's equity, or it should be under contributions. Same thing with a savings account. If it came from the owner, it shouldn't be just sitting in opening balance equity. It should be sitting in the owner's equity account. So you always want to make sure that opening balance equity account is 0. And if it's not, you want to go back and fix that. And the way you fix it is by asking yourself, where did the money come from? And then post that accordingly. So once you have gone through and proved your balance sheet numbers, then you want to take a look at your profit and loss. Now, we skipped over one number here, and that's your net income. This net income number is what is generated from the profit and loss. So we're going to flip over now and take a look at the profit and loss. So we can scroll back up to the top, and then I'm going to click on this thing that says Back to Report List. And when I click on profit and loss, I'm going to do it for the same date. And if we scroll down, we should see that that's our net income number that was carried over to the balance sheet. So once we know that the balance sheet number is good, to prove the profit and loss is mainly just making sure that everything is in the right bucket. Because you've already reconciled your accounts, you've already verified that accumulated appreciation is posted, you've already verified that your interest is posted on your loan accounts, you've verified your accounts receivable and your accounts payable. So here, you're just going through and making sure things are in the right bucket. So we have some design income, we have some discounts given, and this is correct for the discounts given number to be negative. That is correct. We have some landscaping services. We have some job materials that we charged for, and we have some labor installation and maintenance and repair, some pest control services, some product income, and some miscellaneous services. And it reflects our total income that we've earned. Now, my recommendation, and this is one of the things that I do every single time I review a file, either for a periodic file for a client that I'm reviewing or prior to doing a tax return, I will click into every single one of these line items, and I'm going to look at the entries on that particular account to make sure, does it make sense to me? Are these posted where they are supposed to be posted? So I'm going to go line by line and click into each one of those categories and make sure they are posted properly. Now, one thing that you want to do, I see right here, for instance, under the automobile account, you've got one sub account and then you've got transactions that are going to a parent account. There's no point in only having one sub account. If you're going to have one sub account, you don't want to have things posting to a parent account. So always create the sub accounts to equal the transactions that you have. Or if you're only going to have one sub account, don't even bother. Just put it all to automobile expense. There's no need in having something posted to the parent account and something broken out into the sub account. So if we keep on going down the list, we have some expenses and so forth. Now, I will point out to you right now that this profit and loss is not the cleanest profit and loss. And the reason I say that is because we have this little cost of goods sold number up here, but then we have all this other stuff that's technically a cost of goods sold also. In other words, equipment rental is a cost of goods sold and it belongs up here. Job materials, these are a cost of goods sold and they belong up here. So if I was reviewing this financial report, I would say that no, things are not where they belong on this financial report. And I would want to go into the profit and loss or into the chart of accounts, and I would want to rearrange these to get these expenses where they belong. Ultimately, you want your financial reports to be able to tell a story for you, to tell a story for your business, to be able to say, okay, this is the amount of money that I'm making. This is the amount of money that it's costing me to make that money. And then these are my expenses for overhead. For instance, you're not going to have equipment rental just for the sake of having equipment rental. The only reason you're going to have equipment rental is for the sake of having that job. So that's going to be a cost of goods sold. Whereas you're going to have insurance regardless. It doesn't matter if you have work or not, if you have a job to perform it on or not, you're going to have insurance. So insurance, therefore, is not a cost of goods sold. It's going to be an expense. So when we look further down the list, again, we have some legal charges that are posted under the parent account instead of broken down into the sub accounts. So you would want to take a look at the detail of this and appropriately post it in one of those sub accounts. We only have one sub account for maintenance and repair, so there's no real point. You might as well just put that in the parent account or break it into an additional sub account if needed. I would also go through here and group some of these office expenses. Like for instance, I would make rent or lease a sub account of office expenses. I would make utilities a sub account of office expenses. So there's some rearranging that needs to be done on here. And as long as the numbers are good, it's not going to change your bottom line here. So just because, some of these cost of goods sold are posted as expenses, it's not going to affect the bottom line. What it does affect is your story. The other thing that I see here is this miscellaneous category. You should never, ever, 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 ever have anything in miscellaneous. You always want to identify what that miscellaneous item is and put that in the correct bucket. So for instance, here we've got insurance. We've got Hicks Hardware, which is very likely either a cost of goods sold or an inventory item. We have Tim Phillip Masonry. That should be a subcontractor expense. So don't ever post anything to miscellaneous. Make sure that every single category or every single transaction belongs in a particular category. So just to summarize, be sure that you are reviewing your financial reports on a regular basis to make sure that they're accurate. I see business owners and bookkeepers all of the time who are posting transactions, but they're not looking at the financial reports to make sure that those transactions are posting correctly. So if you start with your balance sheet, prove all of your numbers, and then flip over to your profit and loss, make sure your accounts are all in the right buckets, then you can move forward with confidence that your numbers are accurate. Be sure to like this video and subscribe to our YouTube channel for more tips and tricks on QuickBooks Online.